The double-edged sword, navigating line of credit pitfalls in financial services. For businesses in the demanding financial services sector, accounting firms, tax offices, advisory practices, managing cash flow can be a constant balancing act. The promise of a line of credit often appears as a welcome safety net, a flexible financial tool to bridge gaps, fund growth, or navigate the cyclical nature of revenue streams. It offers quick access to capital, a lifeline when needed, but this readily available credit can be a double-edged sword, luring businesses into pitfalls that can strain their finances, increase stress, and even jeopardize their long-term stability. Understanding these dangers is the first step towards sound financial stewardship for the very professionals who advise others on it. The primary allure of a line of credit is its flexibility. Unlike a traditional loan, you draw funds only when needed and pay interest only on the amount borrowed. This seems ideal for a tax practice managing the lull before peak season, or an accounting firm investing in new software ahead of anticipated client growth. However, this ease of access can mask underlying issues. One of the most common pitfalls is treating the line of credit as an extension of cash flow rather than a short-term financing tool. When it's used to cover routine operating expenses month after month, it often signals deeper problems in billing, collections, or overall profitability that are being papered over, not solved. Then there are the costs, which can be deceptively complex. Many lines of credit come with variable interest rates. In an economic climate like we've seen leading into mid-2025, where the rate fluctuations can be unpredictable, what starts as an affordable borrowing cost can escalate quickly. Squeezing margin, introductory teaser rates can also obscure the long-term expense. Beyond interest, firms must be wary of hidden fees, draw fees each time funds are accessed, annual maintenance fees regardless of usage, and sometimes even non-usage fees if the credit line remains untouched. These can accumulate, adding significant burden. Perhaps the most insidious danger is the potential for over-reliance, leading to a persistent debt cycle. A financial advisory firm might use its line of credit to smooth out a period of slow client acquisition, intending to pay it back quickly. But if the new business doesn't materialize as expected, or if client payments are consistently delayed, the balance grows, and the firm finds itself borrowing more just to service existing debt. For owners of smaller practices, who often provide personal guarantees for these credit lines, this cycle doesn't just threaten the business. It puts personal assets, homes, savings, directly at risk. This is a heavy burden for professionals who dedicate their careers to safeguarding the financial health of others. Furthermore, high utilization of a line of credit can negatively impact a business's credit score, making future financing more difficult or expensive. Using the short-term facility to fund long-term assets or ambitious expansions without a concrete, swift repayment plan is another common misstep, creating a dangerous mismatch in financial strategy. Escaping these pitfalls, or avoiding them altogether, requires diligent financial management within the financial services itself. While lines of credit can serve as a strategic purpose for genuine short-term needs, robust internal processes, particularly around revenue collection, are the true bedrock of financial stability. This is where modern technology can offer a powerful advantage. For accounting, tax, and other financial service professionals, effectively managing their own billing and invoicing is paramount. It's here that tools like TaxApp Pro make a significant difference, helping these businesses secure their own cash flow and reduce their dependence on external credit. TaxApp Pro is designed with the specific needs of financial professionals in mind, providing a suite of features to streamline and optimize the often challenging process of fee collection. Its invoicing capabilities, for instance, allow firms to create and send professional, branded invoices with ease. This not only enhances the firm's image, but also ensures clarity and accuracy in billing, reducing disputes and delays. For services rendered on a recurring basis, such as monthly bookkeeping or retainer-based advisory work, TaxApp Pro can automate the invoicing process, ensuring timely billing without manual intervention. This consistency is vital for predictable cash flow. The platform doesn't just stop at sending invoices, it provides crucial visibility into the entire accounts receivable pipeline. Professionals can track when invoices are sent, viewed by the client, and most importantly, when they are paid. This transparency allows for proactive follow-up. TaxApp Pro further assists by enabling automated payment reminders for overdue invoices, a task that can be time-consuming and uncomfortable to handle manually, yet is critical for accelerating collections. By making it easier for clients to pay, perhaps through integrated online payment gateways accepting various methods like credit cards or ACH transfers, TaxApp Pro helps reduce the friction in the payment process, leading to faster receipt of funds. By equipping financial service businesses with these robust invoicing and billing features, TaxApp Pro directly addresses one of the primary reasons firms might turn to a line of credit, managing cash flow gaps caused by slow or inconsistent client payments. When fees are collected more efficiently and predictably, the firm's own cash reserves are healthier. This reduces the need to draw on external credit lines to cover operational costs, thereby avoiding the associated interest, fees, and risks. Ultimately, it empowers these professionals to practice the same financial discipline and proactive management for their own businesses that they advocate for their clients. A line of credit can be a useful tool, but it demands respect and careful management. For financial services businesses, the path to true financial strength lies not only in relying on borrowed funds, but optimizing their own revenue cycle. With dedicated platforms like TaxApp Pro streamlining fee collection, these firms can build a stronger financial foundation, ensuring that the advice they give is powerfully reflected in the health of their own practice. This proactive approach to their own finances is the best defense against the pitfalls of debt and the surest route to sustainable success.